we on here, JC?
I think
Hello?
we're on. I think
Okay.
we're on. You know what that sounded like? It sounded like when I used to go to church a lot when I was into Catholic school.
What, like the organ?
Yeah. It
Okay.
reminds me of St. Teresa and Coral Gables. Shout out Miami. Shout out.
All right. Yeah, that was very. I don't know what that music was. If it wasn't quite ominous, it was I don't know. It was soothing. It was soothing. Anyway, everyone, welcome to the show today, or the stream. Obviously, it's President's Day. U.S. markets are closed, but we don't stop here. JC doesn't stop, and
No.
we are doing this special technical analysis boot camp on Wednesday. But JC, I guess, just like could not wait.
Couldn't do it.
You
I couldn't
couldn't
do it.
wait
They
2
wanted me
extra
to.
days.
Couldn't do it.
You
Let's
couldn't wait
go.
2 days.
I couldn't. The market's open. Everything's open all over the world. Nobody in the world. I mean, I care that it's George Washington's birthday. Like, I think that's cool.
Yeah.
You know, like I'm like a American history nerd and I like all that shit. But like the rest of the world doesn't give a damn about GW or his birthday, right? Or America's celebration. The markets are open. German DAX is acting funky out in Germany. There's the bond market continues to deteriorate. Small caps rolling over. They keep telling me that small cap breath is improving. Like, what drugs are these people on? Like, there's no breath improvement in small caps. Like,
all right, let's set the stage for the day. What is on the agenda here?
All right, ready? So here's the agenda, right? So I'm not exactly Mr. like masterclass guy, boot camp guy. I'm not good at all that stuff. So bear with me. So this is the best I could do. And then you guys tell me how I did. All right, so today's agenda, right? We're going to get into trades right away. Because you know what? The way I learned it is you got to give the people what they want, right? You got to give them what they want. You got to give them the trades, right? Spencer, am I learning?
You got to give the people what they want.
Got to give them what they want. Nobody wants to hear JC talk about the bond market. Enough with the bonds, JC. Enough with the Polish zloty. Give us the trade. I get it. I hear y'all. So we're going to get into the trades right away. Then what are we going to do? What are we going to do next? Let's see. How does this work? Okay. Why bonds are a dictatorship. You like how I did that there? Bonds are a dictatorship. This is not like a democracy. It's not like JC gets a vote or Spencer or Straza or Sean. Bonds are going to dictate what the markets do. You don't have to like it. But the bond market this is it. This is it. I love Bitcoin. I've owned it forever. We've made a lot of money. Cryptocurrencies, DGen, GM. Like, I'm all about that. I own real estate in the metaverse. I'm all about the crypto stuff, right? Chris Dixon's new book, fantastic. I'm almost done with it. Highly encourage it. But cryptocurrencies don't matter. It's $2 trillion in assets. It might as well be zero. The bond market, now we're talking 130 trillion, right? So do you see the difference? So just to put things in perspective, the bond market is the bully. The bond market is going to decide which way the stock market's going to go, right? That's just what it is. So we're going to talk about why that's important. We're going to talk about technical analysis versus fundamental. Few people have as many fundamental friends as I do. I have so many fundamental friends, CFAs for days. Love them. Love them. I'm going to tell you what the difference is between what we do and what they do, right? Even though, let's be serious, they do the technical analysis stuff too. They just don't like to brag about it like I do. We're going to bust some myths of improving market breadth. Spencer, you are a keen observer to market commentary. You're seeing a lot of this breadth improving stuff, right? Seeing it?
Yeah, I'm seeing, yes. Objectively seeing a lot of comments on the Twitterverse or whatever you want to call it.
It ain't true. It ain't true.
I'm seeing a lot of people saying it is. I don't know what to think.
It's just not true. It's not true. We're going to take the bullish side, right? Because contrary to popular belief, I don't have narratives. I think narratives are stupid. The data comes in. You can either acknowledge it or not, right? Like the way I learned it, a great way to get the direction of stock prices wrong, a really good way to do that is to ignore the direction of stock prices, right? So for me, I don't want to get the direction of stock prices wrong, so I focus on that. So it's not that like I'm a perma bear or a perma bull or now I have like this narrative or whatever. The data comes in, we acknowledge it, and we act accordingly, right? So I'm going to take the bullish side, throw out some of the more bullish arguments, which are very easy for me to make. And I also have really smart friends that are making those arguments. So let's address each one of those. I think there's a few stocks that are about to take a dump. They are already dumping. And I think they continue lower. We're going to talk about 3 key technical tools. I promised you a little sneak peek at the boot camp on Wednesday. So we're going to talk about 3 technical tools that I think are helpful for everybody. So at the very least, let's say you hate all my charts, right? Let's just say you hate all my charts. At least you get some fun facts about technical analysis, and you get some technical tools that you could then take home to do or to your work to do what you want to do. So let's say I suck, you still win, right? So you got that going for you. And then more trades, right? Spencer, you see what I did there? You got to give the people what they want, right? Spencer,
You got to start strong. You got to end strong. You can't be like pancakes where you start strong and then by the end you're sick of them. You gotta.
what I do is when I get sushi, I think you've seen me do this. I start with the uni and I end with the uni, right? So I bookcase the uni. Maybe sometimes I mix a little uni in the middle, but I definitely want to bookend the uni. So that's how I roll. So here we're doing the same thing. This is JC's proprietary uni strategy. When you're ordering sushi, you bookend them. That's the
All
move.
right.
All
Anyway,
right.
on to the trades.
All right. Let's go. Give the people what they want. Ready? We're shorting service now. Let's go. This thing has 0 written all over it. No, I'm just kidding. Listen, I'm not like Mr. like gloom and doom, bubble's gonna pop, the Fed ruined everything, the Trump's gonna ruin everything. Like, like all these conspiracy theories, like they're cute and everything, but like I'm not gonna give you one of those. Like, I don't have any of those. I don't give a shit. Like, I'm too old for that stuff. I just want to make money in the market and then go hang out with my family and go eat some delicious food and drink some good wine. I'm easy. Watch a football game, I'm easy. I don't need all these, conspiracy theories in my life. And maybe some of those conspiracy theories might be true. I don't know. I just really don't care. I want to sit down and watch the Heat game and eat a steak, with my kids, right? So I think Service Now is a great short. Obviously, Spencer, I think, dropped the link on Wednesday at the boot camp. We're going to talk about the exact levels, how we want to execute that, an options trade that we can add an additional layer of both risk management or leverage, depending on, because that's really the key here. We all have different objectives. We all have different time horizons. Just because I want to short Service Now tomorrow, and cover a month from now or something like that, that doesn't mean that you need to liquidate your 401k. You know what I mean? Like, there's a time and a place for everything. So we're going to talk about it on Wednesday. But Service Now, you wanted to trade? Look at that. On a relative basis, already breaking down, momentum rolling over, which is very characteristic of this type of stock. A lot of these software stocks, remember the software index just hit its former highs from a couple of years ago, just now getting there. So you think it's just going to rip through like there's no resistance? I don't, what is it from Home Alone? I don't think so. Right? Do I have the movie quote right, or am I screwing that up?
I don't know if you have that one right.
I don't think so. I think that's Home Alone, right? Can somebody give me a thumbs up if I got that one right?
Maybe.
All right, I'm losing my touch. I haven't seen Home Alone in a minute. All right, so Service Now, I really like all these momentum divergences rolling over. And then here it is. All right. So again, we can't have a real civilized conversation like adults about the stock market without looking at what the bond market is doing, because this is the one that is going to move the markets. This is the one that's going to prove that you buying stocks for the back half of Q1 was a good idea, or if shorting stocks for the back half of Q1 was a better idea. Like, I don't get to decide. Like, it's not up to JC. I wish it was. Life would be easier, but it's not. It's up to the bond market. So what I'm looking at down below here in the blue, you're looking at, oh, you know what I can do? I can do one of these fancy things, right? I can, look at me now, huh? Who's fancy? All right, so here we're looking at credit spread. So these are high yield junk bonds here in blue relative to U.S. Treasury bonds. So as the blue line is going up, that means that the market is more inclined to buy junk bonds, meaning they're more willing to take on more risk relative to the safety of a U.S. Treasury bond. So when these lines are going up, essentially credit spreads are narrowing is really what that means. That is indicative of a healthy market environment. Investors are being rewarded typically in those environments for owning stocks. And sure enough, that's the environment that we've been in, of course, since October. It's not a coincidence that as the stock market, Dow ripped 6,000 points in 3 months, this blue line was going up. Credit spreads were tightening. That makes perfect sense. So what happens when stocks are under pressure, however, is that credit spreads widen. Money is more incentivized to go into the defensive areas of treasury bonds versus the more aggressive, more risk-on high-yield junk bonds, of course, right? So you'll see this blue line down below start to go down. So what is it going to take for that blue line to go down? Well, these high-yield junk bonds up here in black are going to have to break this top, right? Complete this top, start to fall at a faster rate than treasury bonds have been falling now, which, by the way, is tough to do because treasury bonds have been getting the crap kicked out of it, right? And we're going to zoom in on that in a minute. So what is it going to take from the bond market to prove that it is unwise and perhaps even foolish to be long stocks? I believe it is a breakdown and completion of this top of the high yield bond market to catch up with what the US Treasury bond market is already doing. So it's the denominator fallacy to a certain extent, of course, but nevertheless, bear with me. If the Treasury bond market is absolutely collapsing, the mere fact of junk bonds going sideways is credit spreads staying narrow, right? So if the junk bonds start to roll over, look for those widening spreads, which tends to happen when stocks are getting crushed, right before a good rug pull. And as you can see here, Treasury bonds rolling over, making new multi-month lows relative to stocks are already making all-time lows. So if relative strength means anything to you, Treasury bonds clearly lack plenty of it. So JC, why do I care about Treasury bonds, bro? My grandmother buys Treasury bonds. I'm YOLOing Tesla. I get it. The reason that Treasury bonds are important, again, to reiterate, it's what's moving markets. Let's take Apple, for example. I'm old school. I'm old enough to remember when Apple was a big deal, arguably the biggest deal, until like all of a sudden now Apple doesn't matter. Why doesn't it matter? Because Apple's getting the crap kicked out of it and it goes against your bullish narrative. That's why Apple doesn't matter anymore. Call me old-fashioned. Call me old-fashioned. I'm a traditionalist, right? Traditionalist. Treasury bonds going down and Apple going down are happening simultaneously. That's not a coincidence. Tech stocks don't like rising interest rates, and interest rates are making new multi-month highs as we speak. My understanding is that stocks have been doing so well because of lower rate expectations. Well, then why are rates making new multi-month highs and treasury bonds getting smacked? Sounds to me like that narrative is pretty stupid. Here's Apple making new multi-year lows relative to the Qs. Look at this massive top. Massive top in the world's most important stock. That's bullish. So we're definitely short. Definitely getting short Apple here, no question. And we'll talk about some of those details on Wednesday. I know Spencer dropped the link, and you can see it in the show notes of the video. But the biggest stock in the world, or second biggest now, I think Microsoft is. Microsoft looks pretty crappy too. I think I want to short that one also, but we'll talk about that on Wednesday. Dell, hello. Look at this piece of crap. First of all, how the hell did Dell get up here in the first place? I don't know. Again, I don't get a vote, but it doesn't look like it's going to stay up here for long. Notice how momentum was not even able to get overbought. Woo! Woo! When that happens, things are going to get nasty. Woo-wee! Nasty. And I plan to be very aggressively short throughout that entire period. So we'll talk about, again, the details of that coming up on Wednesday. So you see, Spencer, you give the people what they want. You give them some nerd stuff. You give the people what they want, more nerd stuff. You see? How am I doing?
So far, so good.
Not bad. Not
Chat's
bad.
with you. Chat's with you. I mean,
Chat's with me.
I have I have comments and questions and concerns, but this isn't a debate. So I will save. And by the way, if you have any questions in the chat, I would encourage you, drop them in there. We will save time at the end for some good old fashioned Q&A as it pertains to what JC is talking about. But anyway, let's keep going.
Let's do a little history lesson, and we don't have to go back to the 1960s or the 1990s or the Great Depression. Like, we could just kind of stick to the current cycle. Of course, we study history and we look at all of those markets and we learn from the past, of course, but we're only going to be able to make money in this cycle, the way the correlations currently are, not the ones that were there in 2006 or in 1992. right? We got to make money this cycle, right? Listen, I'm a historian too. I get it. But it's just not like 92 or '06 or even 2019. We're just in a different market environment. So let's take a look at why. So here's the treasury, here's the US dollar. And then down below is the US 10-year yield, right? Benchmark interest rates. Notice how these two lines are moving together, right? So once the dollar bottomed in July, right, and interest rates started really ripping, stocks did poorly, right? Stocks did really poorly in this environment here, right? For a few months, really got smacked down. People were talking about bear markets. Sentiment was really down in the dumps. And of course, we were buying stocks very aggressively as we saw the US dollar finally put in its peak on October the 3rd, right? So this doji right here is what we like to call that candle. That was October the 3rd. That is the day that the new lows list peaked on the New York Stock Exchange. Ever since then, stocks started to go up. Now, the S&P 500 and the NASDAQ didn't make their final low until the end of October, right? Just a few months ago. But by then, most stocks had already bottomed. Right? They bottomed on October the 3rd, which is when the dollar peaked. So as interest rates were still going higher into the back half of October, the dollar was already rolling over. The new lows list was already disappearing, right? There was already improvement of market breadth. And then, of course, dollar got destroyed. 10-year yield got destroyed. Bonds absolutely ripped. Stocks did great. Dow rallied 6,000 points in 3 months. Unbelievable. Fantastic. By the way, those 3 months are historically the best 3-month period of the whole year. November, December, January, especially right before an election. Stocks did great. What do you know? Guess what? We are now entering the worst time of the year to own stocks, the worst 2-week period of the year, right? Terrible time to own stocks. And what's been happening is that the US dollar is up. The US dollar index futures specifically are up 7 weeks in a row, every week this year. 10-year yield is also making new multi-month highs, while they're telling you that stocks are making new all-time highs. But the new highs list peaked 2 months ago, December the 14th. Things have been falling dramatically since then. So the question is, since the dollar bottomed, you've seen bonds get killed, right, with the dollar ripping, and the S&P 500 has continued higher. Most stocks have not, but the S&P 500, the index itself has, right? So I think I don't want to say misleading people because there's nothing misleading about the S&P 500, but I would argue maybe it's blinding people that only look at the index and say that's the stock market. You're not getting all of the information, right? Like we have friends in Michigan. It's like, oh, the Michigan Wolverines won today. It's like, well, did they beat Ohio State or did they beat the Fighting Chippewas of, right? Like, you got to put things in perspective. So here's the bull case, I think. This reversion here in the dollar, stocks were relatively resilient during that period. I can make that argument. I'll buy that. And we'll talk about why, right? It's not like stocks are getting destroyed. They're just not going up, right? So I get that. So the bullish argument is, okay, the dollar bounces here. Great bounce for the dollar and yields for that matter. And stocks held in pretty good. I could buy that, right? I could buy that. And then the dollar has now retraced exactly 61.8% of the entire decline that we saw from October to the end of the year, right? The fourth quarter decline. We've retraced exactly 61.8% of that. So if we're below that and you want to be long stocks, I mean, I'm not going to do that, but I can understand that philosophy. Be like, all right, well, if the dollar breaks out, then all bets are off. Okay, fine. Knock yourself out. I would rather bet that the dollar is going to rip higher and confirm that, yes, shorting stocks is going to continue to be a good idea. When the dollar peaked here, right? Here, when the dollar peaked, you could see that high beta relative to low volatility also peaked. So when stocks are in a healthy market environment, and we're talking about credit spreads narrowing, the dollar weakening, what you see is the index is going up. You're seeing high beta stocks outperforming low volatility. That's what you see in healthy market environments. In more defensive times, when stocks are under pressure, like they've been for the last 2 months, if you've bothered to look and count, the majority of stocks have been not going up. Now, we're going to talk about how they haven't started going down yet. And we're going to talk about how we quantify that in a second. but they stopped going up. Meanwhile, low volatility stocks are outperforming high beta, which tends to happen just prior and during an environment where it is more beneficial to be shorting stocks versus buying them. And we're going to talk about these correlations on Wednesday. The links on the show notes to Wednesday's boot camp, live boot camp. And you know what's great about the boot camp is that not only are we going to talk for 3 hours about how we do all of this analysis, so you can do it yourself, but you get to access to All Star Charts Premium for a month too. So now you get to see it in real time also. So I really like that. And we talk about these correlations all the time, in our premium channels. So consumer discretionary and consumer staples are very important. This is a consumer-driven economy, so I'm told. But when it comes to the market, in healthy market environments, like high beta tends to do well, credit spreads tend to be tight, the dollar's weakening, like all of those environments where stocks do well, consumer discretionary outperforms consumer staples. So discretionaries are places where we consumers spend our discretionary income, home builders, retailers, automobiles, right? Those are consumer discretionaries versus staples, things we're going to buy no matter how bad the economy gets, toilet paper, cigarettes, booze, right? Like just those are consumer staples. Laundry detergent and stuff like that, right? So those are staples. So the ratio between the two is very informative of what the market is, the health of the market. Well, new highs in the S&P, lower highs in the ratio between discretionaries and staples, which again, we see all the time right before a good rug pull, which is one of the reasons why we are betting on a good rug pull. Which brings me to the next nerd topic of the day, technical versus fundamental, which is very simple. Technical analysis is the study of the behavior of the market and therefore market participants, as opposed to the goods and the services in which that particular market deals. So again, we're interested in the behavior of the markets. Obviously, we're looking at price as our primary indicator because as technicians, well, everybody knows this, not just as technicians, asset prices trend. We know that. They're not random. Like we have the data, also common sense. You could just see line go up, line go down, like they trend, right? But all the white papers are out there too. Knock yourself out. Andrew Lowe has done a great job at MIT, but there's a million others. Asset prices trend. Fact. Also, momentum exists too. Fact, right? It's just data. It's just math. So forget the momentum for a second. Let's just stick with asset prices trend. If we know that, and we know that there's a higher likelihood for a stock that's going up to continue to go up versus just completely reversing on the spot and starting to go down, right? If we know that the probabilities are skewed in one direction or another, maybe we should spend the majority of our time looking for trends. And these trends last a long time, right? And what's also great is that the market is fractal, meaning in the same way that markets behave over the long term, looking out decades, century, when you look at 10-minute charts, 1-hour charts, daily charts, weekly charts, you're gonna see the same patterns. You're gonna see the same behavior. You know why? Because the asset classes might be different. Markets might evolve over time, but it's us, silly. It's us. We are the constant. We are the ones that remain the same, which is why the chart of Bitcoin and Doge and whatever shitcoin, pick a shitcoin, go compare it to the charts that Edwards and McGee were talking about in the 1940s. And you know what? They're going to look exactly the same because it has nothing to do with the Doge or, RCA or whatever Edwards and McGee were looking at the time. It's all about human emotions and understanding. That's why I like to say when technical analysis is the study of the behavior of the markets, by definition, it's also the study of the behavior of humans. So I really like to, understand. Annie Duke does a great job. I love all her work. Thinking in Bets is great. Daniel Kahneman, obviously. Thinking Fast and Slow, go read that. All the Daniel Crosby books. He's the man. Anything written by Brett Steenbarger, read that. Denise Shaw, shout out Denise Shaw, Andrew Maneker. There's a lot of great thinkers of humans. Our own very own homie, Dr. Phil Pearlman, of course. So understanding the way humans behave, sentiment, psychology, that's what's driving markets, not fundamentals. It's positioning that's driving markets, right? Fundamentals are focused on companies and earnings and things like that. And that's great. But if you're interested in making money in the market, and we know that in the market, asset prices trend, we want to focus the majority of our attention on the price direction, right? The direction of the prices of assets, right? Versus worrying so much about the company. If you want to worry about the company, knock yourself out. But again, if you're interested in making money, and we are, our focus is on where the money is, right? Why? Who was it? What was the famous bank robber? They asked him, they're like, "Oh, why are you always robbing banks?" He's like, "Because that's where the money is." Who was that? That was anybody remember that one? All right. Another bullish case is that we have yet to see an expansion in the new lows list. You know what I love about this one, guys? This one is just math. Just math. You cannot possibly have a correction or a bear market of any kind without stocks going down. That's right. You see, like the simplicity of that, right? Mathematically, it's just math. Like not JC's opinion, or the guy on TV, or this guy. Just math. Cannot have a correction in the market without stocks going down, right? I mean, I'm not like trying to be like the Yogi Berra of technical analysis. It's just that's just what it is. So if we know that, we can reverse engineer the new lows list, and we know that we're not going to see anything in the new 52-week lows list anytime soon. There's nothing going on there. S&P's at an all-time high. But if you're looking at the 10-day lows list, 21-day lows list, 30-day lows list, like baby steps. Let's start small. We're not getting anything there. Nothing. So there's going to be no correction. There's going to be no rug pull of any kind. Most of our shorts are probably going to stop working if we don't get an expansion of new lows. And again, it's just math, right? It's not like my opinion. It's just math. It's not about the economy or the Fed. Just math. Love that. So this is the New York Stock Exchange composite, which in my opinion is the most important. I mean, they're all important in their own ways, but the New York Stock Exchange composite is a pretty good list of stocks. Half the biggest 100 companies are not even American, so you're getting foreign exposure. You're not getting like the tech heavy focus of the NASDAQ, right? Like they all have their place, but the New York, gun to my head, the New York Stock Exchange composite, the companies in them, right? The index too, but the list of companies to me is a big one. Here's a Russell 3000. Also important, represents approximately 98% of all investable assets in the U.S. equities market. So kind of a big deal. No expansion in new lows at all. Yeah, JC, but financials and industrials making new highs, JC. Yeah, I see them. I see them. Like like Dave Chappelle. I see it. I see it. New highs in financials and industrials. So, JC, we need to buy stocks because of this. All right. Is this really where you want to be buying financials as we're finally getting back to those former highs, key extension off the COVID lows? This is where you're going to buy financials? Like, I know this is cute and everything. Like, this is great. New highs. Yeah, I see it. I see it. But is this really where you want to buy financials? Right? Like, as we're running into those highs, like, after absolutely ripping 25% in 3 months. Yeah, now? The joke for us internally in November and December was that we didn't have enough long bank exposure. Like that was like literally like the joke, like joking, not joking, like guys, we don't own enough banks. That was in November. Here we are on the back half of February. Now we're going to buy the banks. Feed the ducks, you can have them. How about the other one? But JC, it's the small caps, JC. The small caps, breadth expansion in the small caps, JC. Right? That's the one I got. Well, let's see, right? Let's actually count. So small caps peaked on December the 27th. That was the day that the US dollar index bottomed. Probably not a coincidence. It was also the day that the US 10-year yield bottomed. Probably not a coincidence. So the day the dollar and the US 10-year bottom is the day that the small cap index peaks. Also the day the advanced decline line peaks. All right. Well, let's see how each of the small cap sectors has done since that date to see if, in fact, we are getting breadth expansion in small caps? And the answer is no, right? It's a big fat no with an exclamation point. With an exclamation point. Small cap industrials are the only sector that is up. Only one. One. Yeah, that's where you're going to hang your hat. So financials and industrials, financials running into their highs. Small cap industrials are the only ones that made a new high. Yeah. How about we take out the most important stocks in the industrial sector, which is difficult to do because industrials are not like technology where two stocks are half the index, or or discretionary where you got heavy weightings in an index, or even energy, right? Industrials don't have any stock that represents more than 4% of the whole index. It's very diversified. But again, I'm old school. I'm old school. Dow Theory, Charlie Dow, let's go. Springfield, Massachusetts, 1886. Let's go. Come at me, bro. I'm old school. Charlie Dow, Dow Transports. The transportation stocks with industrials, to me, have to be the most important industry group. Pick a more important. Engineering and machinery? I guess, maybe. It's transports. And guess what? Transports are making new multi-year lows relative to the rest of the market. That ain't good. So you want to talk to me about industrials? I see small cap industrials very, very lonely there at the top. And then I'm seeing the most important industrials breaking down on a relative basis. And then when I zoom in on the Dow Jones Transportation Average itself, whoo-wee, that momentum divergence is nasty. Woo, nasty. Do not go in there. Woo, right? On Wednesday's boot camp, we're going to dive heavy into Dow Theory because there's this belief out there that Dow Theory means industrials and transports, right? Dow Jones Industrial Average makes a new high. Transports have to make a new high. Industrials make a new low. I get that. But that's not even in the top 5 most important Dow Theory tenants. Not even top 5. Barely in the top 10, if you really want to go there. So on Wednesday, we're going to talk about the 5 most important Dow Theory tenants that are way more important than transports and industrials confirming one another. So that's going to be on Wednesday's boot camp. I'm so hardcore Dow Theory. I used to read Dow Theory's letters. Every morning, I would read one of the letters. For years, I did that. And, if you took out the dates and changed the names around, you really wouldn't know that was written 130 years ago. It's really fascinating. So we're going to talk about all that stuff on Wednesday. Here's the other one, JC, semiconductors. They, AI, it powers the universe, the world. It's, changing the way we live. I know. I'm in favor of it. Great. So while you have these mega heavy names making new highs, on an equally weighted basis, semiconductors are nowhere near new highs. So the bullish argument is, well, JC, because, the biggest companies are getting all the contracts, blah, 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 AI, change the world, the future, bro. I get it. And just because on an equally weighted basis, they're also not making new highs, for me, I don't find value in a market cap weighted index outperforming an equally weighted index. That doesn't give me a lot of information. That's more stock specific in a lot of cases. So I'm more interested in whether these equally weighted indexes are going up or down on an absolute basis, treating them on their own, right? So I'm not comparing it to the other one. It's not a ratio. It just ain't going up. It ain't going up. Looks like a lot of other stocks, right, that aren't semis is really what it looks like. And then when you look around the world, German DAX looks vulnerable. And by the way, what's interesting about the German DAX, let's see. What's interesting about the German DAX is that you're not getting technology in there, right? You're not getting any technology at all. You have one tech stock in the German DAX. You got a lot of industrials in the German DAX. Right? Momentum rolling over hard. Something to watch, looking overseas. Also, Japan took them long enough, 25 years. 35 years, excuse me. Wow, 35 years. What was I doing in 1989? Whew, man, I was 7, right? I was 7 years old, 42. Japan is my favorite place to visit in the whole world. So don't misconstrue my pessimism here about the Japanese Nikkei 225. Man, Japan is freaking awesome. Go to a baseball game. Go to a sumo event. Oh my God. The sumo championships in Tokyo was crazy. It was like the NFL meets WWE. It was insane. Highly recommend. Anyway, 35 years later, we're back to the 1989 highs. There's an old, debate, even amongst technicians, of whether there's still market memory going back 10 years, 15 years, 20 years. Well, how about 35? We're about to find out. We're about to find out. And I'm not going to sit around waiting. Feed the ducks. I'm out. See ya. Right? You can have it. I'm in like show me mode. I got to see it. Right? Let it consolidate. Let it dance. I got to see it. We've been bullish Japan for so long. There's been such a great trade for so long. Mission accomplished. This was always our target. So if that's the case, then now we're going to pretend it wasn't our target. Now it's like, oh, but it looks so good, bro. And the AI and that's not how I roll. Mission accomplished. Moving on, right? You want to own it, knock yourself out. We're moving on. All right, 3 technical tools that I promised, right? 3 technical tools. And then I got a couple of trades that I think you guys are going to like. So number 1, for God's sakes, seriously, for God's sakes, it is not, don't fight the Fed. That's not what it is. It never was. It still isn't. I know they love to scream that on TV. Don't watch that, right? Like it never was, don't fight the Fed. Never. It was always, and I quote, rest in peace, Mr. Marty Zweig. And I quote, rule number 1, don't fight the tape. The trend is your friend. That's it. The trend is your friend, with benefits, I might add. Don't fight the tape, right? So that's what we follow. And then, just to make matters even more clear, when you go down the list of Marty Zweig and you go all the way down to number 6, if you can even get that far, what does he say? Rule number 6, don't fight the Fed. Parentheses, not as valid as rule number 1. End parentheses. Rule number 1, the trend is your friend, don't fight the tape. Rule number 6, don't fight the Fed, parentheses, not as valid as rule number 1, end parentheses. So, are you going to listen to rule number 1, or are you going to listen to rule number 6 with a Barry Bonds asterisk on it? To me, the answer is very clear, right? Shout out Marty Zweig. Rule number 2, or technical tool number 2, is chart construction. And again, I hate to keep bringing up dead guys. I feel like such like a doomer over here. But Alan Shaw, he just recently passed away. Rest in peace, Alan Shaw, huge mentor to me. When you hear things like the bigger the base, the higher in space, that was him. The bigger the top, the harder the drop. That was Alan Shaw. Also, what did Alan Shaw say? In bull markets, stocks are expensive and then they get more expensive. And in bear markets, you'll find that stocks are cheap and then they get even cheaper. That was Alan Shaw also. So I had a great conversation with him years back, sort of wanting to put this to bed, a couple of things to bed. Number 1, this all comes back to chart construction. Number 1, do you want to use logarithmic charts or arithmetic charts? And, in other words, do you want to look at absolute price changes or percentage price changes? Alan Shaw, he's the man. I'm not going to argue with him. Logarithmic, right? Looking at the percentage changes. Because going from 5 to 10 is a 100% move, right? But going from 90 to 100, right? Or 95 to 100 is not a 100% move, but it's still the same 5-point move. And then the other one is price only, right? When we look at our charts, we're not looking at dividend adjusted total return charts. when we're analyzing supply and demand. There's a place for total return charts. Like if you want to see how much money would I have made in the last 6 months if I was in SPY versus if I were in IWM or something like that, and looking at a total return, that's one thing. But looking at supply and demand, market participants remember what they paid for it. They remember where they sold it, right? It's the price only. So when you see some of these dividend adjusted charts, you're getting misinformation, and it makes life more complicated. So price only. And then finally, my third technical tool, to me, is a balance to be able to sleep at night. And that's what technical analysis allows us to do. It allows us to put ourselves in a position to be able to sleep at night, because we've all been there. And if you haven't been there, try to get there as fast as possible so you can stop that nonsense, right? So if you haven't been able to sleep at night, start behaving more recklessly so that you can not sleep at night and learn how that feels. I've certainly been there. Talk to traders, who've done this for decades. They'll tell you the same thing. So how do you sleep at night? Well, it's twofold. And this is really where it's impossible to do without technical analysis. But so it's two things. Number one, you don't want to lose money, right? We work hard. We've made all this money. We don't want to give it back, right? Like I work too old for this. I need to keep my money, right? That's priority number one. Now, at the same time, we're trying to make money. This is what we're doing. We're investors, right? I don't care what that guy did or that guy did. I'm worried about numero uno, me. So I want to be able to make a lot of money too, right? So it works both ways. And by being able to position ourselves, because if I'm not long enough sometimes, or in this case, short enough, if I don't have enough risk on, I have trouble sleeping at night. Like, what am I thinking? What am I doing? How am I not more short Apple, in this case, or in November? How are we not long more banks? Like I'm not actually unable to sleep at night. It's more of like a, philosophy, but those are the things I was thinking about at the time. Those are the things I'm thinking about now. In other times where but I'm managing risk properly. In other times where I've just had way too much exposure and it's going against me and I don't know what to do, I'm not sleeping at night. I'm worried. I'm waking up in the middle of the night, checking the price of some shit coin, or sugar futures at 1 o'clock in the, like I've been there. No way to go through life. But I think you have to go through that to really understand that's not how you want to live, right? So those are my 3 technical tools. The trend is your friend, understanding chart construction, logarithmic charts, price only charts, and then finding a balance between enough risk that you're not worried about missing out and you have exposure, but at the same time, you're protecting yourself to the downside so that you're able to sleep at night and you could go do other fun stuff that you like to do. Go skiing, go hiking, spend time with your family, whatever you like. And you're not worried about the YOLO you put on, mortgaging the house. You know what I mean? Like that's no way to do it. All right. Let's talk about some trades. By the way, how was those 3, Spencer? I thought that was pretty good. How'd I do? Not bad, right?
Pretty.
I have a lot of
pretty good. Pretty good.
Pretty good. I have a lot of old school friends that I hear things over the years. You hang out with enough old guys, old technicians, you hear a lot of war stories, you pick up a few things. So those are a few things that I've picked up both from the old school guys and through my own experiences, of course. Always best when it's both. So what's got JC's panties in a bunch? As they say, technology represents 30% of the S&P 500. It represents 50% of the NASDAQ 100. I don't make the rules. That's just what it is. It's just math. You might not like it. You might say it's justified. You might say it's too much weighting. You might say it's not enough weighting. I don't know. It doesn't matter what you think. Technology is 30% of the S&P, 50% of the NASDAQ. Oh, yeah. I forgot to mention. In that representation of technology, it does not include Google or Meta or Tesla or Amazon. None of those are technology stocks. So in addition to the 30 in the S&P and the 50 in the NASDAQ, you can add all those as well. You do the math. If technology is rolling over, and momentum is certainly pointing to that. So here we're looking at technology relative to the rest of the market. This is it. This is heavy duty right here. If that breaks, see ya. The rug pull is here. So you can see some of the most important stocks. Some people are like, oh, it's just Adobe, JC. It doesn't matter. just one software stock, JC. It doesn't matter. All the other ones are so good. It's just one cockroach, JC. Yeah, maybe. I don't think so, though. You can see Amazon, Freudian slip. Adobe here making new highs on a relative basis had already rolled over a long time prior. A long time prior. And when you see these massive collapses, I don't know whether Adobe is a massive collapse or not. I guess we'll see. My crystal ball's in the shop, so I don't know what's going to happen next. I just know that the trends are not up. And as we mentioned before, asset prices trend. So maybe it's just Adobe. Maybe. I don't think so. When you look at like financials, for example, people are like, oh my God, JC, the great financial crisis came out of nowhere. Who saw that coming? Well, financials relative to the S&P looked exactly like this before the great financial crisis. And I'm not saying that we're going to go into a great technology crisis or whatever, maybe. But that's not even the point. The point is it looks exactly like this. And here's the service now, same thing, similar philosophy. Software stocks are getting back up to those former highs, right? They're breaking down on a relative basis, completing massive tops. It's a weight of the evidence thing, right? So I know we talked about a few trades, Apple, Dell, Adobe, ServiceNow. We're going to talk about all the details and how to execute that as part of the boot camp on Wednesday. So the beauty of it is if you're at the boot camp on Wednesday, that makes you an honorary premium member. So you get access to all the research. So it's not one of those things where it's just educational and then you got to pay for the trades. Like, no. It's all at once. So you're going to see the technical tools and learn how to use them and then see them applied in real time in the current markets, right? By the way, I'm not Mr. Gloom and Doomer. Just to be clear, I really don't give a damn what the market does. I used to when I was younger. I used to be like, oh, but if the market goes up, so many people make so much money and people's retirements and blah, 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 rainbows and butterflies. I used to be one of those people. I did. I used to rainbows and butterflies. That's just not how the world works. Sometimes stocks go up, sometimes stocks go down. Like I can't worry about Pepe's 401k, or Martha's, SEP account. Like that's not my problem. I got to worry about me and my family, right? And if I think stocks are going to go lower, I'm going to try to profit from that, right? And if maybe the stock goes down and a bunch of people get fired, and I have no control over that. I'm just here to make money. And in the same way that we're making money with these short trades and options trades on these shorts, I think there's opportunity on the long side, energy in particular. You've seen that defensive tilt in energy that bonds used to have. Remember when stocks would fall and bonds would rally? Bonds were a safe haven. That's where the 60-40 portfolio comes from. But now stocks and bonds are moving together. So the 60-40 portfolio is really just 100. It's really just 100. I think energy is that other 40 sleeve. It's no longer bonds. And I don't think it's going to be anytime soon. In fact, bonds crashing is a big reason why we're shorting stocks. Right? So here's the refiners ETF. When you look at all the oil and gas stocks, none of them are doing very well at all, except the refiners. So look at refining and marketing companies. This is the index fund CRAK, C-R-A-K, looking to break out to new all-time highs. We want to be buyers of that breakout. Look at Valvoline, one of the components. Marathon Petroleum, another one. Phillips 66. There's some interesting names here. These are small cap names. This is a $5 billion company, mid cap or whatever. But you're not going to see, small caps and mid caps like in technology are like 60 billion. That's just the nature of the beast. In energy, it's just not like that. Transocean used to be a $150 billion company or something. Now it's $2 billion, for example, right? So in black, you're looking at crude oil relative to the S&P 500. In blue, you're looking at energy stocks relative to the S&P 500. Perhaps bottoming here, meaning moving forward, energy and oil will be outperforming the stock market. And then just to show you some of the intermarket work that we do, we'll talk about this in Wednesday's boot camp, Spencer. I know we got some new people here in the chat. Drop the link there. Wednesday, we're doing a live boot camp. One of the things we're discussing is intermarket analysis, everything you need to know. 3-hour boot camp. Nakisaki is a good one. This is Norway's currency relative to Sweden And it looks an awful lot like the ratio between energy and the S&P 500. Notice how this one's been one step ahead every time. So look at Nakisaki already putting in higher lows going into the summer as crude oil was still underperforming before the turn. Notice how Nakisaki was already rolling over going into Q4 as crude oil was still outperforming S&Ps. And now notice that Nakisaki is already ripping higher while crude oil has remained underperforming throughout January, underperforming the S&P 500. That has recently now changed, right? So this is some of the intermarket work that we do to help us make decisions. So you might not be trading the Nakisaki. I, for one, do not, but it's something worth keeping an eye on. And then here's crude oil relative to the S&P, zoomed in, momentum, putting in a bullish divergence as well. So we're seeing it all over. And then, guys, let me just finish up with this. This is kind of just a good list to take home with you of different lines that need to start going up if you think your stock portfolio is going to go up, if you think the S&P 500 is going to go up. Advanced decline line on the New York Stock Exchange. Here we're looking at the dollar inverted. So as this line's going down, that means the dollar's going up. So you need this line to go up, meaning the dollar's going down. Consumer discretionaries versus staples been rolling over all year. Need that to pick up. Treasury bonds, hello, they need to stop crashing. Like, they don't even need to go up. They just need to stop crashing. They've been crashing all year. And you've seen that deterioration in market breadth, intermarket relationships rolling over. Next thing that we expect to see, if this is a severe correction, is an expansion in the new lows list. And we're going to talk about why we look at all these things, how we put the pieces of the puzzle together, technical analysis 101, and of course, a lot deeper strategies and tools. And you're going to see it applied in real time. And we're going to talk about all our favorite trades, how to execute, where our stops are, and some options trades to both leverage those opportunities and for others, manage risk in those opportunities, or a combination of both, depending on who you are, because that's what it all comes down to. What is your time horizon? What is your risk tolerance? What are your overall objectives? They're going to be different than mine, right? And that's okay, right? That's a feature, not a bug, right? That's the way it's supposed to be, which is why when we talk about a position, I'll tell you, I'm doing it this way, but you could do it that way, or you could do it that way, and all of them make sense depending on what you're trying to accomplish. So we're going to go over all that on Wednesday at the boot camp. What did I miss? Did I miss anything? We want to do a little Q&A? We talked about a little Q&A, right?
We have a few questions from the chat that I wrote down.
Sure.
Let's do a couple right now. This is from
All right, what do we got?
from Adam Evans. When you say rug pull, can you quantify what that means with the backdrop of the primary trend being higher?
Yeah, it's how the kids talk these days.
It is
with the rug pull.
Yeah.
It really tied the room together.
Right.
They peed on your rug. It really, it's just a figure of speech that you could see a correction at the index level. When you talk about within the context of the primary trend being up, yeah, specifically what we're describing is a rug pull at the index level, but the primary trend has not been up for the majority of stocks, not for the last couple of months. So we take a weight of the evidence approach here, and we go one by one and look at all of the stocks and see, is the primary trend up, or is it sideways, or is it down? And for the most part, it's sideways, some down, some up. So an expansion in the new lows list would confirm that now more of them are actually going down versus the majority just stopped going up. There's a big difference between the market getting worse and, or the market getting less good and then the market getting worse, right? That's really what it's about. But based on the weight of the evidence, I've been doing this a long time. I've seen this story before, and we've bet accordingly, and that we've done well doing that. And if it what is it? If it looks like a duck, walks like a duck, talks like a duck, then it's probably not a chicken.
That's what they say. And I think, just to be honest, when JC says rug pull, frankly, rug pull is a figure of speech. I don't think anyone really has a quantifiable definition.
Yeah, how are you going to quantify rug pull?
For what a rug pull is. I never even heard the term before, like 3 years ago or 4 years ago, right? So it's this thing from crypto that permeated our culture, and it just means, as JC said, a fall in prices.
It's just how the kids talk,
Right.
We try to keep it fun around here.
All right, JC, from S. Amalan, these charts make it look like stocks will drop for a longer period, not just a month. Why do you think the pullback can turn around and the charts will show we're going up in a month or so?
Yeah, I mean, I'm still in the camp that we're in a structural bull market that started 20 months ago. I'm not seeing any evidence that suggests otherwise, especially in the most important areas like financials, coming out of a 15-year base, industrial sector rotation. You look around the world and many of these countries, there's nothing, these are not in structural downtrends, quite the opposite, right? So I think bigger picture, there's just a lot of health in this environment, but that doesn't mean that we can't see a correction. Now, with that being said, every large market correction started out as a small one, but not every small one turns into a big one, right?
True.
So my suspicion, based on the weight of the evidence, is that come back half of March, we're going to be doing some serious accumulating of equities. Sentiment is going to be super bearish. You're going to see it in the put call ratios. You're going to see it in the sentiment polls, AAII. You're just going to see it. This just isn't that. You have a very you got Biden coming out tweeting about how strong the stock market is. Really, bro? Really? You're seeing you're seeing these parabolic moves in like SMCI and Nvidia, and like that story's very sexy. So like it checking off all the boxes, right? For somewhat of a correction. It might be through time, it might be through price. My suspicion is both, but I think that is a pullback that we probably want to be buying. Again, we'll worry about it when the time comes, but my suspicion is that's a dip that we want to be buying going into the back half of the year.
SMCI didn't look so sexy on Friday. A couple more real quick, and then we'll get out
Yeah,
of here.
but what happened prior to that is
I
very
know, I know, I know.
characteristic of
Okay,
the end of a run.
couple more. Dan, when comparing two stocks to each other for relative strength, do you place more emphasis on the recent trend or the longer term trend? Like
I mean,
the
always
last year, or like 3 months, or
for
three
me, the
years out?
bigger trends are dominate, right? It's a multiple time frame analysis. You
Okay.
start with the bigger trends and then you zoom in, right? And I find daily charts and weekly charts much more actionable than a monthly chart, right? Going back decades, right? So I like to zoom in more specifically, but I think the longer term trend is definitely more important, but less actionable for tactical opportunities. Like look at this chart that I'm showing right here. This is a chart going back 4 or 5 months, right? Like we're focused on right now and the divergences that we're seeing right now, not necessarily massive decade long tops and divergences, right? We're talking about
Okay.
literally right now.
Yep. Okay. A couple more quick, JC. Since do you believe crypto is a risk on asset that will follow this rug pull?
Listen, it's a good question. It could, but it's so small that it doesn't have to, right? Like all of these intermarket relationships are intertwined with one another, and these are huge market caps. Crypto's so small, and there's
Yep.
so much inflow into these new ETFs that who knows? Maybe it could buck that trend. Gun to my head, if the S&P gets a 10% haircut, Bitcoin ripping in that environment, probably not, but it wouldn't surprise me. So I think that now more than ever, I think if you like Bitcoin, then buy Bitcoin, right? Manage risk responsibly, of course, but I think now more than ever, maybe you could treat it separately. I know I personally am, whether that's right or wrong. Um, Listen, if the stock market's getting killed, I have a hard time believing that cryptocurrencies are just going to be ripping higher. It's certainly possible. I doubt it, though. I doubt it.
Okay. Chris Dawson, JC, when would you be wrong here?
When would I be wrong?
Maybe that's a question we save for Wednesday. Like
Yeah,
what would make you wrong? I think that's the
yeah,
question.
no, and we'll definitely talk about that on Wednesday. But
Yeah.
a big part of it is when our shorts stop working, right? Like a lot of the stuff we've been bearish on have been going down, and volatility's been going up. So if you're long put options, when
Yep.
price goes down and volatility goes up, you make money. So when like that stuff stops working, yeah, we'll leave it at that.
All right.
We'll get into the details on Wednesday, but
Yes, we will.
that's a good start.
It's a great start. So again, if you haven't seen the graphics up on the screen this entire time, not sure how that's possible, but there is a link below in the description as well. You can use that link or use the link on the screen to sign up for Wednesday's boot camp, 5 p.m. Eastern time.
3 hours.
5 p.m. Eastern time Wednesday on that link. If you are a member of All Star Charts Premium, you have received an email with a link for how you can access it. If you are not a member of Premium, then you can use this link right now to get access to Wednesday.
So we're going to talk about all the intermarket relationships, a lot of which we didn't even discuss today. We're going to talk about how we break down the market from a top-down perspective. Remember, All-Star Charts originally started out as an institutional research platform for traders at hedge funds because I was managing a hedge fund and our LPs were traders at other hedge funds, whose PMs you might be familiar with. And they weren't allowed to trade stocks in their own portfolios, right? They had to give it to somebody else. So this is how this started. So everything you're seeing are the tools and the strategies that are being used at the world's top hedge funds, and I can attest to that because I'm speaking with these traders every day. Also, a lot of the big financial advisors, a lot of the independents that have left, the Morgan Stanleys and the LPLs of the world and like the big firms and started their own firms. They don't have that other research. Not that those firms are known for their great research or anything like that to begin with, but just in general, the independent financial advisors with 300 million, 500 million, a billion, 4 billion, 10 billion that don't have their own internal research staff, they come to us. So what you're seeing is what the biggest and the best are using to make money professionally. And we're able to give it to you at an affordable price, which I think is pretty cool. And it gives us, great, I get to talk with you guys all day long. It's fantastic. I learned so much. So
All right,
appreciate it.
those of you who are new here, if you're watching us on stockmarkettv.com, you can click that little YouTube icon in the bottom right, head on over to our channel. You can subscribe, get notified every time we go live. We do a morning show every single market day, Monday through Friday, every day the market's open, 8:30 a.m. Eastern time. It's a little bit, it's not as focused, it's more broader, and we don't get into specific trade ideas like we do here, but it's a fun show. We have fun. So come hang out there tomorrow, every day at 8:30. Subscribe to our channel on YouTube, and that's what I got. Thanks for watching, and JC, I'll see you tomorrow morning for the morning show. The rest of you,
And
if I don't see
if
you
you're
there,
out there, if you're out there listening, if you're not there on Wednesday at 5 o'clock, you should be ashamed of yourself. It's going to be so sick. So it's going to be awesome. So I hope you're there.
all right. How do I want to end this thing? What's the best way to end it? Maybe I'll just click on a random video and see what happens. How about that? All right. See you guys.
Adios.